Hey everyone, welcome back to Upside Down Data. Let's talk about the euro. Even if you've never traded the foreign exchange, if you've traded crypto at all, you're used to thinking about asset or currency ratios. Crypto is a lot like Forex in that way because, we trade Bitcoin for US dollars, but we also trade between Bitcoin and altcoins. And the most interesting ratio out there right now is the ratio of the euro to the US dollar. So that's what we're going to talk about today. So if you guys like the content, subscribe to the channel, give the video a like, and let's get into it. The euro is way down. Here we see the monthly chart. For something with such a long history, looking at these long time frames helps to put things in perspective. And what's apparent is that the euro's value has just dropped below parity, meaning it went below the value of one US dollar. And that was the first time that that happened in more than 20 years. After dumping below that level, the euro bounced a little bit and it's now sitting just above and try and hold that critical level of $1, sitting at 1.009. There are jokes going around right now about how the euro is supposed to be a stable coin, but like Terra's UST, it lost its peg. That's obviously tongue in cheek, but it's a useful reminder that although it's true that crypto is risky, it's not as if mainstream currencies are risk free by any means, especially at a time like this in the global macroeconomy. So, anyway, when you see something like this, especially if you've been around through a few cycles of booms and busts in the market, whether that market is stocks or crypto or Forex, it looks like a potential opportunity. When something drops this dramatically in such a short period of time, it makes sense to look for some mean reversion, meaning a return to a more stable middle ground. It's not really that different from trading between, let's say, Bitcoin and Ethereum as the ratio between them fluctuates, which is a very common strategy that people use in the crypto space. This is an analogy that might come more naturally to you if you're someone who watches crypto channels on YouTube, but the principle is the same. So, you might be tempted to fade this move and to bet on a rebound, meaning you might want to buy some euros here with your US dollars. That would be kind of a natural thing to consider. And what prompted me to talk about this today is that a family member asked me about this exact strategy. And like I said, it makes perfect sense. Usually the equilibrium between the dollar and the euro has been, that €1 is worth a bit more than $1. It has recently spent time at about the 1.2 level. So, the theory is it should return to that equilibrium eventually, right? Well, maybe. It's just that there are some problems with assuming that the decline in the euro will be temporary or short-lived. First of all, there's the global macroeconomic uncertainty at the most general level. The euro is certainly not spared from that. Even if the European economy had strong fundamentals right now, which it does not, it would still be affected by economic contractions in its major partner economies like China. But it's really worse than that because Europe isn't just experiencing inflation and economic contraction like every other economic zone. Um, Europe actually has a very special problem, which might help to explain what's going on with the euro, and that's the war in Ukraine, Russia's war in Ukraine. For one thing, Russia is, as part of that campaign, implementing a deliberate strategy to cause economic pain on Europe. Russia wants to weaken Europe's ability to support Ukraine. That's a strategic consideration. And it also wants to punish it for its attempts to do so. So at the same time, um, Europe is experiencing global macroeconomic uncertainty and specific economic problems right in its backyard. Um, at the same time, Europe is also retaliating and responding, and it's imposing sanctions on Russia that cause pain not only to Russia but to Europe too. These new sanctions that the EU added in early June include a partial oil embargo on Russian oil. So the Europeans have now lost access to a primary source of cheap energy, and that has ripple effects through every sector of the economy because you can't produce or distribute anything without energy, And you can't have a cost effective business model without cheap energy. So this dynamic is likely to continue driving up costs and putting pressure on the euro. And I don't think there's much of a basis, or at least a very specific basis, for expecting that to change soon. Um, as I mentioned, the cause is Russia's deliberate strategy to cause economic pain in Europe, and Europe's strategies to punish Russia for going to war. So it's not the case that the European economy will bounce back at whatever pace it would be capable of doing if it were left to its own devices. What's happening is that Europe is learning the hard way about allowing itself to become reliant for a critical resource on another country that has occasionally been an ally, but more often in recent history has been an adversary of the European Union. It's also worth noting that this development is not, really a surprise to people who've been paying attention and who understand the European economy. Um, for some added context, I'd recommend watching this Bloomberg interview. This was recorded all the way back on May 2nd, and the person being interviewed is Christian Kopf. The key takeaway from this interview with regard to the euro is that this war presents a long-term source of not just uncertainty, but interference in the European economy. So even with European countries, with Germany taking the lead, um, trying to develop solutions to gain energy independence from Russia, the success of that and the timeline of that are really uncertain. And even more importantly, the process of gaining energy independence will cause some pain that can further bring the euro down. At the end of the interview, Kopf is asked to make a prediction for the next few months on the euro. And remember, this was on May 2nd of 2022 when this interview took place. And he predicts that the euro will head toward parity with US dollar. This is 10 weeks before that actually happened. So the point is, this is not really a surprise, given how the last few months and the last few years have gone. It's not a huge anomaly in how the market is pricing something that can be exploited easily. That kind of thing does happen. It happened with oil, for example, in 2020, when the price of a barrel of oil was negative briefly, and some people made a killing on that. This is not a black swan um, like that. This is a predictable outcome that reflects structural changes in the European economy. If we go back to the chart, we can gain some more important perspective. One of the clearest features of this chart is the downtrend that the euro has been in since 2008. The euro has had some strong periods since then, each lasting, about 6 months to 2 years. The most recent rally in the euro went from May 2020 to a peak in January 2021, so a pretty short one there. And even then, it made a lower high than the previous high back in February of 2018, let alone the previous highs in 2014 and 2011, 2009, and of course 2008. So, guys, the euro looks bearish. So hopefully this sheds some light on the question of what to make of this move on the euro. I hope you guys found it useful. Thanks for watching.